Hello friends, welcome to Gupta Education World. In my previous video, I had explained the income tax slabs and tax treatment of mutual funds in detail with example for assessment year 2018-19 and assessment year 2019-20. If you have missed the video, you can find the link of the same in the description part of this video. And please subscribe the channel to get the notifications of newly uploaded videos on time. Friends, in this video, I will explain you the tax treatment of equity shares including bonus shares, right issue of shares and stock split of shares for assessment year 2018-19 and assessment year 2019-20. So please see the video till the last to get the proper understanding of tax treatment of shares. So without wasting your time, let's begin the topic. I am receiving various queries regarding tax treatment of shares. How to calculate cost of acquisition, whether that will be on FIFO basis or weighted average basis. How the bonus shares are taxed. How the shares received in right issue are taxed. What is the tax treatment on split of shares, face value. Whether any change is there in assessment year 2019-20 for taxation of equity shares. Firstly, we will see the kind of capital gain. Capital gain is of two types, long-term capital gain and short-term capital gain. For listed shares, if you have held these shares for more than 12 months, it is called long-term capital gain. But for unlisted shares, the period is 24 months. And rest of the capital gain is short-term capital gain. Now we will see the long-term capital gain on listed shares for assessment year 2018-19. If the following conditions are satisfied, then the long-term capital gain in case of equity shares is exempt. But the condition is that the sale should be done through recognized stock exchange, for example BSE or NSE, and the securities transaction tax has been paid on the purchase and sale transaction of such shares. However, condition of STT payment is waived for genuine cases. For example, if you got the shares through initial public offering or bonus issue or right issue. Now, long-term capital gain on listed shares is taxed from the assessment year 2019-20. And if the following conditions are satisfied, then the tax payable is at the rate of 10% in case of long-term capital gain more than 1 lakh per year, and the conditions we have already discussed in the previous slide. However, LTCG made up to 31st January 2018 will not be affected. Only the gains made after the date will be taxed. This is called grandfathering provision. For example, Mr. A purchased 1500 shares of XYZ Limited at Rs 200 on 1st March 2016. On 31st January 2018, the highest price of that share was Rs 250 per share. He sells the shares at Rs 350 on 10th April 2018. So LTCG will be calculated using the price of 31st January 2018. So the gains will be only Rs 1,50,000, that is 1,500 into 350 minus 250. Out of this, Rs 1 lakh will be tax free in a year and only Rs 50,000 will be taxed at 10% plus applicable cess and surcharge. The shares which are not covered in the previous slides will be taxed at the rate of 20% of capital gain with indexation benefit. These shares are unlisted shares and listed shares who doesn't fulfill the conditions mentioned in previous slides. Now, short-term capital gain on listed as well as unlisted shares for assessment year 2018-19 is taxed at the rate of 15% of capital gain. Please note that while calculating capital gain, STT paid in case of listed shares is to be excluded from the cost of acquisition and to be included in sales consideration. Now the question is, when we are selling any shares, but cost of acquisition we have to take. For the purpose of taxation, the method for calculation of cost of acquisition is FIFO basis. In this method, it is assumed that whatever shares you have purchased first, you will sell those shares first. For example, Mr. A has purchased the 100 shares at Rs 10 per share of Z Limited on 10th May 2017 and 50 shares at Rs 12 per share on 1st June 2018. He sold out of this 60 shares on 20th July 2018. In this case, cost of acquisition will be considered as 600, that is 60 into 10, that is by FIFO basis, and not rupees 640 by weighted average method. Now we will see the tax treatment of shares received in bonus issue. For tax calculation, the cost of bonus shares will be considered as 0. For the time period of holding of bonus shares will be calculated from the issue of the bonus shares and not from the date of purchase of the original shares. For example, Mr. B purchased 1000 shares of Z Limited on 1st January 2016 at Rs 150 per share. On 1st May 2017, Z Limited declares bonus as 1:1. So Mr. B got 1000 shares in bonus issue. Now Mr. B sold 2000 shares at Rs 100 on 1st July 2017. In this case, long-term capital loss in case of original shares is Rs 50,000, that is 1000 into 100 minus 150, and long-term capital gain on bonus shares will be Rs 1 lakh, that is 1000 into 100 minus 0, that means 0 acquisition cost. Now suppose in previous example, shares are sold after 31st March 2018, then the cost of shares will be assumed to be the higher of the highest price of share as on 31st January 2018 and the actual cost. Let's assume that the highest price as on 31st January 2018 is Rs 120 and he sold the shares on 10th June 2018 at Rs 130. In this case, long-term capital loss on original shares is Rs 20,000, that is 1000 into 130 minus 150, and 150 is calculated by taking the higher of Rs 150 or Rs 120, and long-term capital gain on bonus shares will be Rs 10,000, that is 1000 into 130 minus 120, that is higher of Rs 0 and Rs 120. Now we will see the tax treatment of shares received in right issue. For tax calculation, the cost of these shares will be considered the actual cost paid for the shares, and the time period for holding of these shares will be calculated from the receiving of the shares in right issue and not from the date of purchase of the original shares. For example, Mr. C purchased 1000 shares of Y Limited on 1st January 2016 at Rs 150. On 1st May 2017, Y Limited gives the existing shareholders an option to purchase more shares at Rs 50. So Mr. C got 1000 shares at Rs 50 in right issue. Now Mr. C sold 2000 shares at Rs 200 on 1st July 2017. In this case, long-term capital gain for original shares will be Rs 50,000, that is 1000 into 200 minus 150, and short-term capital gain on right shares will be Rs 1,50,000, that is 1000 into 200 minus 50. Suppose in previous example, if shares are sold after 31st March 2018, then cost of shares will be assumed to be higher of highest price of shares as on 31st January 2018 and the actual cost. Let's assume that the highest price as on 31st January 2018 is Rs 220 and he sold the shares on 10th June 2018 at the rate of Rs 230. In this case, long-term capital gain on original shares will be Rs 10,000, that is 1000 into 230 minus 220, that is higher of rupees 150 actual cost and rupees 220 the price existing on 31st January 2018. And long-term capital gain for right issue of shares will be rupees 10,000, that is 1000 into 230 minus 220, higher of rupees 150 or rupees 220. Now we will see the tax statement of stock split of shares. Sometimes company splits their shares face value from rupees 10 to rupees 5 or rupees 1, and they gives the fresh shares for the fresh face value. So in that case, the cost of all shares will be divided proportionately to the original and split shares, and the time period for holding the split shares will be calculated from the date of purchase of the original shares. In this example, Mr. D purchased 1000 shares of Z Limited on 1st January 2016 at Rs 150 per share. On 1st May 2017, Z Limited splits the shares face value from Rs 10 to Rs 5. So Mr. D got 2000 shares of face value of Rs 5 each in place of 1000 shares of Rs 10 each. Now Mr. D sold 2000 shares at Rs 120 on 1st July 2017. In this case, cost of acquisition for all the 2000 shares will be 75, that is 1000 into 150 divided by number of new shares, that is 2000, and period of holding will be from 1st January 2016. So long-term capital gain will be rupees 90,000, that is 2000 into 120 minus 75. Friends, I hope you understand the concept of taxation for equity shares for assessment year 2018-19 and 19-20. And if you find any difficulty, please mention the same in comment box. And if you like this video, please press like button and share this video to your friends and colleagues. Please press on subscribe button and bell button to get notifications of videos uploaded by us in future. Thank you friends. Jai Hind and Vande Mataram.